Arguably, the single most important thing about a company is their financials, the income statement, the balance sheet, and cash flow statement. Now, why is that? The number one reason, in my opinion, is because money never lies. Money is always neutral. It always speaks the truth. There's a reason why people like Kevin O'Leary on Shark Tank continuously says the only thing that matters is money. And the reason for that is very simple. The main focus of a business is to generate money. Therefore, the finances of a company is what either makes it or breaks it. And I'm going to explain to you what makes a good company in terms of their financials. I'm only going to be covering what I believe to be important, and by no means am I a financial expert on large corporations, nor am I a certified financial advisor. So I advise you take this information with a grain of salt, research it, see if it's true, see if it's not true. With that being said, let's take a look at Google's finances. There's two places that I recommend you use to view the company's financials, and that's Yahoo Finance or the company's own website. So for this example, we're just going to use Yahoo Finance. And at the top here in the search bar, we can either type in the name of the company or we can type in the ticker symbol. And this first part, the summary, I covered in another video. I'll link it down below if you guys want to check that out. For this video, we're just going to check out the financials. So we're going to head over to the tab here that says financials. And what we can find is the income statement, balance sheet, and cash. Now, first off, the income statement reports the company's revenues, what they make, and their expenses, what they spent money on. The first thing you'll want to look at is the operating income or loss. What differentiates it from an income or a loss is if this number is positive or negative. In this case, it's positive, so it's an operating income, which is what we're looking for. And this number is the amount of money that the company has after their expenses. So if we take here the gross profit, which is $91.8 billion, since all numbers are in thousands, minus the operating expenses, which is $56.2 billion, we're left with 35.6. So in other words, when you get a paycheck from work, that amount is your equivalent gross profit income. Then the money that you spend on rent, food, your car, all of those bills are your operating expenses. Then the money that you have left over, that's your operating income. Now let's say, for example, you don't have enough money to pay all your rent and car and electricity and all that. Then instead of an operating income, that would be an operating loss, which is obviously bad, and we want to avoid that at all costs. So the next thing we want to look at is their net income, which is the money that they have after taxes. And then when it comes to the income statement, the last thing I'll take a look at is how much money they've made throughout time. In 2016, their net income was 19 billion, then it dropped down to 12 billion, then it skyrocketed to 30 billion. Now they're at 34 billion. So it's easy to say that this company is growing, and that's a very good thing, and that's what we're looking for. So now that we've covered the income statement, let's move on to the balance sheet. And what the balance sheet is going to tell us is all of their assets and liabilities. The assets are items that have a cash value. For example, cash, buildings, cars, planes, etc. Liabilities are items that the company owes, like a loan or a line of credit. In simpler terms, the liabilities is the debt that a company has. First thing that I like to look at in the balance sheet is the net receivables, which is money owed to the company, because this is money that the company will receive. And if we scroll down a little bit, we can easily see total current assets and total current liabilities. So a good strategy to have is to divide the two, the total current assets and the total current liabilities. So if we have 152 billion 578 million divided by 45,221,000,000. Typically, as an investor, I like this number to be above 1. In Google's case, 3.3 is an extremely good number. As long as it's above 1, that's where you want to be. Anything under 1, that means that they have more liabilities than assets, which is not good. Lastly, I'll look at the history of the total current assets and liabilities. Obviously, it's a good thing that the current assets are growing, which is Google's case throughout time. But is it a good thing that they're taking on more debt? This depends, because maybe they're taking on more debt to fund more projects, more buildings. Unfortunately, I can't really tell you if this is good or bad in terms of what company you're looking into. You're going to have to do your own research and make a judgment call. Now, on the last part of finances, we have the cash flow statement. And the cash flow statement tells us where the money is going to and where it's coming from. The net income is the same as before when we saw in the income statement. So it's not like there's different types of net income, it's all the same one. Now, the first thing I look into here is the net cash provided by operating activities, which is the amount of money generated by their operations, which is pretty self-explanatory, really. And just like with previous examples, you want to see this number growing throughout the years. After the net cash, the thing that I'll look at most in a cash flow statement is the stock-based compensation and common stock issued. Now, the common stock issued is how much money worth of shares have been created in the market. In 2018, for example, they used $950 million to create more shares in the market so it can be available to more people. And stock-based compensation is the amount of money that Google spends in giving their employees shares. Now, these three items, stock-based compensation, net cash provided by operating activities, and common stock issued, can be compared to see if the company is referred to as what's called an OPM, which stands for Other People's Money Company. Now, in this case, I'm going to use Uber's cash flow statement to explain this. Now, you can see that their current net income is pretty bad. They're not generating any income, and the cash provided by operating activities is negative, therefore it's non-existent. Now, if we take a look at common stock issued, in 2019, we can see that there was almost $8.5 billion of common stock issued. That's because they merged with an IPO to go on the public market. So they used all of the money from investors such as yourself to give to their employees. And as far as researching a company's finances, that pretty much does it. Again, this is only what I believe to be important and what you should be looking into as a beginner. Please do your own research. Make sure everything checks out. Make sure everything that I say is actually true. Don't just take my word for it. Let me know what you think, or if you have any questions in the comments, and I'll be sure to answer them. Thank you for watching and happy investing.